Hey everybody, Marty Mazzora here. It is the afternoon of March 25th, 2025, Tuesday, with your midweek market snapshot. I'm going to keep this one really quick. Not a lot to talk about, and I think my first note here in this morning's log, or my only note so far today, pretty much says it all, and that is that, and this is related to the equity market, by the way, while the optimism that the planned tariffs from the Trump administration won't be as draconian as feared helped boost the market yesterday, not much has changed. There's still tons of uncertainty regarding what the planned policies will be, but lower stock prices, which we've seen of late, do make those high levels of uncertainty a little more palatable. So just a quick comment with regard to the planned tariffs. Folks, the tariffs that have already been implemented are actually greater in magnitude than the ones that were implemented in 2018. Now, in 2018, we saw two market corrections, 10 early in the year, 20% in the fourth quarter, and we entered a manufacturing recession amid that trade war. So again, the difference being larger again this go round. However, it was anticipated, and perhaps that has served to quell what might otherwise be a worse market correction. But I think the risk that this correction is not over is still significantly high, which I'm going to show you here in the charts. I also commented here that right on cue with my last video commentary, U.S. equities were rallying hard, and that was yesterday, while Europe was down a bit. So an oversold technical bounce in U.S. stocks, and I think that's still what we're feeling here. That'll likely persist a bit, so it could go further is what I'm saying here. And an overbought sell-off in Eurozone stocks. Bloomberg's Cameron Krice, really good macro analyst in my view, pretty well captures what we see to be the prevailing risk for U.S. equities in his commentary regarding the Fed meeting last week. And essentially, he talks about Powell. In Powell's press conference, he was subject to a barrage of questioning along the lines of, given that you are projecting /saying /have said X, why are you doing Y? In response, he consistently cited the impact of uncertainty as a rationale to sit tight for now, both in terms of Wednesday's decision and guidance for future policy moves, and await further data and clarity. Operative word being clarity, I think. That's exactly what policymakers should be doing. It would be more worrisome if they pretended to know what was going to happen when it's obvious they don't, at least not any more than the rest of us. The equity market has decided that this is all positive and okay. Well, have fun with that, kids, as he says. The prognosis for lower growth and higher inflation for this year is very real, and that's not exactly a happy combination for stocks that are still valued pretty extravagantly by historical standards. I agree with that wholeheartedly. Simon White talks about the fact that we're just not seeing the kind of selling exhaustion, etc., that says that this correction is over. It may very well be, folks. Like I said, it would be, good geopolitical news that might see this market threaten all-time highs once again. In the absence of that, the technicals were telling us that a rebound was very much in the offing, and I'd been illustrating that for you. It just so happened that it coincided with maybe moderately okay news that maybe there's some flexibility on the tariffs, but again, the ones already implemented were not small, and we're talking about quite a bit more going forward. So it's going to be very interesting to see what ultimately transpires next week with that infamous April 2nd looming. So on your screen in front of you, and we're just going to stick with stocks today. I have pulled up here the S&P 30-year monthly chart. We've looked at this a lot over the last few years, and I pointed to this long, rising wedge pattern. A lot of momentum. Not a bearish divergence anymore, but overbought on the monthly chart. And I said over and over again, you don't want to be too overbought on the monthly S&P 500 chart. When we've been there before, if I just go backwards right now, you can say so far it's a 10% correction. Here, a 27% bear market. Here, a 20% correction, then a call it 37% bear market, 16% correction, 60% bear market, 50% bear market. So if we stop here, this will be the best or the least worst of the last 30 years of the market working out of monthly overbought conditions. We do have a negative divergence here on the RSI, a long one. Not a great look. So if you're wondering why we continue to kind of be cautious and stay hedged, technically speaking, you're getting a feel for that here. I pointed to a weekly engulfing candle here recently, and I told you that typically we get a pretty good sell-off for that, and that's this little candle right here. Let me zoom in a little bit, make it easier to see. So an engulfing candle is when the body of a candle engulfs the previous candle, and when you get a bearish engulfing candle, which is blue, meaning the market went down that week near a top or an all-time high, that's a very bearish signal. So right in here, remember I said typically you get more. Well, it ended up being about 10%. It was 10% last time. That wasn't quite an engulfing candle right there, but it was probably close to 8 or 9%, 11%, and so on. On the weekly, still not a good look, battling back above the 50-week moving average, but in terms of moving average, let's focus on the 200-day. So folks, what I've told you here over the last couple of weeks is that we suspect that we would see a rally back to the 200-day moving average, and that would be the norm. In fact, we could battle with that for a while. But if this turns out to be a bear flag, which means it would have to break down fairly soon, then potentially the market goes quite a bit lower and scares a lot of people. Yesterday, it closed just above the 200-day moving average, and today, getting this out of the way, you can see it threatened it and bounced right off of that. So a bull right now would argue that we've broken above it, and now it's acting as support. May very well be the case if you look back historically. Lots of false breakouts above and below this, by the way. So if we do come roaring back, then this was a false breakout. If we turn over here, which would be my base case, based on what I'm seeing, but it doesn't have to turn out that way, obviously, then we have a false breakout to the upside. When we consider momentum, it does look better on the daily chart than it does the weekly and the monthly. We have a short-term buy signal here on the MACD, and coming off of oversold territory. And now I would say we're no longer oversold on any metrics, which actually makes the market now more vulnerable to bad news. Anyway, lots to play out, folks, but no reason yet to let the pigeons loose. This is very classic. This is what a bear market or a correction looks like. You have a swift decline. You have a consolidation. You come back a certain level. Typically, it's as much as half of the decline, and then you roll back over. If indeed this is the beginning of something worse, my fear is that it could be. Therefore, this was not a smart place to go loading up on stocks in our view. And then on the NASDAQ 100 index, which is where these big tech Mag 7s are really concentrated, you can see that it has not been able to recapture the 200-day moving average. Again, here is what I've been talking about, right? You consolidate, you test the 200-day moving average. It has almost tested it there. It virtually tested it here today and failed the test, frankly. So right now, this would still be a very bearish pattern until it moves with force sustainably above the 200-day moving average. The 50-day rolling over, the 20-day rolling over below the 200-day, all of those are concerns. However, like on the S&P, you do have a buy signal right here, short-term on the MACD, and a similar look in terms of the relative strength index. And then lastly, I wanted to show you one breadth indicator that I've been showing for a long time now. You can see this goes all the way back to the end of, the end of 2020. And this is a massive bearish divergence. This is the cumulative advanced decline line for the NASDAQ Composite Index, and this is the NASDAQ Index itself. So you do have a rising wedge pattern, and by the way, we've broken below the uptrend, so that's not a great sign right there, technically speaking. This here basically just speaks to how incredible the impact of just a handful of stocks. Ultimately, they got dubbed the Magnificent Seven right in here on the overall index. Literally more decliners on a trend basis in that index than advancers, even though the index fought its way back up to all-time highs. If you look back historically, when have we had situations like this? Well, the only time we've had it this dramatic and this extended was right before the bubble that burst around the real estate and mortgage market in 2008 and the tech bubble in the early 00s. This was good for an 80% decline in the NASDAQ, and this was good for, call it a 56% decline in the NASDAQ. So not predicting this necessarily. I think valuations at these levels, if they were to right themselves, we are talking a lot lower than here. But again, folks, anybody who's wondering why we're just not, joining that party and pounding the table and say, hey, stocks went down 10%, buy, Magnificent Seven, AI. No, from a valuation standpoint, from a breadth standpoint, and from a long-term technical standpoint, this remains a point to have your wits about you. Let's just put it that way. Folks, thank you, as always, for watching and listening. Hope you have a great rest of the week, and I'll be talking at you near the end of the week or over the weekend. Take care. Bye-bye.